morning, everyone, and thanks for joining us for our October Global FX Outlook. Before we begin, I want to note that the views expressed today represent our analysis based on currently available information. Market conditions and forecasts are subject to change based on evolving data and policy decisions, and nothing in this presentation should be construed as a guarantee of future market movements. Now, let me start by saying what a difference a month makes in currency markets. The dollar has staged quite the comeback. After hitting more than a 3-year low in September, the US dollar index has rebounded sharply, recording its second monthly gain of the year. This isn't just technical noise, it's being driven by resilient US economic fundamentals and a significant recalibration of Fed expectations. The relative strength of the US economy matters significantly for FX. Now, what's particularly interesting is how this dollar strength is playing out differently across currency pairs. The pound has fallen around 3% from its recent peak above 1.37 as UK long-term yields have surged. Now, here's the thing. Markets are viewing rising UK rates as stress signals right now, not a positive carry trade. With the UK budget coming up, there's genuine nervousness about fiscal sustainability. The euro spiked to a 4-year high versus the dollar before reversing course. The common currency remains highly sensitive to Fed policy expectations and US macro data. The ECB has held steady, signaling its cutting phase may be over, but the euro remains vulnerable to shifts in market sentiment. Down under, Australian dollar jumped briefly to an almost 1-year high before bumping into resistance at its 200-week moving average as global risk appetite dwindled and hopes for aggressive Fed easing cooled. The RBA remains cautious amid sticky inflation, which should provide support, but China's economic trajectory remains the wildcard for Aussie dollar performance. Now, let me walk you through 3 critical themes that could dominate markets through the end of 2025 and into 2026. The first theme, market stress has eased. Since peaking in April, policy uncertainty has eased significantly, helping to calm market volatility across asset classes. Earlier in the year, sentiment-driven swings dominated. Now, economic data is shaping expectations more than headlines, and while markets remain reactive, the tone has shifted from panic to patience. Nevertheless, with sentiment never far from the surface, the risk of a sudden swing remains if fresh shocks or surprises reignite uncertainty. Second theme, divergent policy paths. The global easing cycle is fragmenting. The Fed and Bank of Canada both cut rates in September, citing labor market concerns, but further moves are uncertain. The ECB held steady, signaling its cutting phase may be over. The Bank of England and RBA remain cautious amid sticky inflation, while the BOJ remains the global outlier. Broadly, the synchronized easing of 2024 has given way to a more uneven, data-driven landscape, setting the stage for two-way FX volatility. And finally, the third theme, good news is bad news. Risks to US activity are gradually shifting to the upside against still pessimistic pricing. And because markets are pricing in a pivot to easing, anything that delays that pivot is seen as negative. It's a classic case of bad news is good news, becoming good news is bad news when policy expectations dominate sentiment. So ironically, positive economic surprises can trigger equity sell-offs and risk-off moves that reverberate across financial markets. Now, this is $1 million question, literally. Since August, we have been arguing the bar for continued US dollar weakness has risen. And here's what's different now. This year's dollar depreciation has largely been a result of currency hedging and portfolio repositioning, not a wholesale dumping of US assets. While the consensus view has pointed to further dollar weakness toward the end of the year, we've noted several factors that make a continued decline more challenging. These include the resilience of US economic growth, the continuous flaw provided by historical fiscal deficit, a cautious Fed, and a market that has already priced in much of the expected easing. The current US dollar path reminds us of the pattern seen during President Trump's first term, a sharp initial weakening, followed by a sharp rebound. The key difference, however, is that the Fed was in a tightening cycle in 2017, whereas the current backdrop is defined by the prospect of rate cuts. And what this means for corporate treasurers is that the easy dollar, negative view is over. Ultimately, dollar's performance is now more dependent on actual economic outcomes than on speculative bets of a dovish Fed. We do see the dollar index finding support here with upside risk if US data continues to surprise positively. Now, here are the key market events to watch for the month of October. And now let's jump to the more exciting part of the FX. Sterling has pulled back significantly, and let me tell you, the mood around the pound has shifted dramatically from earlier this year. What's fascinating is that this weakness isn't about positioning. The options market shows no significant buildup of bearish sentiment. Instead, we're seeing idiosyncratic flow drivers that are harder to predict and hedge against. So looking at our rainbow scenarios, the Bank of England keeping interest rates elevated due to resilient UK data and persistent services inflation, while the Fed is forced to cut on recession risks, represent our upside scenario for sterling. However, our central scenario suggests policy uncertainty extends, with markets placing enormous weight on UK fiscal policy clarity. UK services, which are a more pervasive driver for the economy, should help the UK escape the worst excesses of our global protectionism. Our upside scenario is pound benefiting from US confidence crisis, while our downside scenario involves a reversal of UK fortunes, with BOE forced to cut rates more as UK falls into recession. Now, looking at euro, we do maintain our constructive view on the pair. And what's driving this is a combination of factors that markets haven't fully appreciated yet. The ECB held steady in its recent meeting, signaling that the cutting phase may be over. And this is actually less dovish than what markets had been pricing, which supports the euro. German fiscal reforms and Europe's defense spending needs stand in stark contrast to fiscal concerns elsewhere. We are seeing defense spending potentially moving to 3 to 3.5% of GDP with some form of mutualization, and that's really a game changer for European growth dynamics. So looking at the central scenario that involves a cautious Fed with little need to rush into cutting rates given resilient economic momentum, while the euro economic trajectory fails to impress. Our upside scenario for euro US dollar involves sentiment weighing on the dollar through continued interference in central banks' affairs. Now, looking at the Aussie, it has been underperforming year to date, but we're actually constructive from here. Our central scenario sees the greenback recovering, with US rates likely to remain above Australian rates, capping the growth in Australian US dollar. The RBA remains cautious amid sticky inflation, but here's what the market are missing. The Australian government plans to boost growth prospects by compensating for cost savings, with another significant fiscal easing according to our upside scenario. Australian data has proved remarkably resilient. The China factor is absolutely crucial here. If China delivers on stimulus expectations and if the US-China talks at the APEC yield positive surprises, Aussie dollar could outperform significantly. Our downside scenario involves escalation of tariffs happening more quickly or widely than anticipated, causing concentrated weakening in Asian trade and commodity prices. And we do see the pair as a preferred way to express monetary policy divergence between the Fed and the RBA. Now, looking at the Chinese yuan, this pair continues to trade relatively stable against the dollar, and this stability is remarkable given the economic headwinds and is actively managed by the Chinese authorities. Our central scenario sees China recovering, improving, with the Chinese government's recent supportive action to the local economy potentially seeing yuan strengthen. Now, what's supporting this view? The convergence of spot US dollar CNY with daily fixings and the narrowing spread between onshore and offshore rates signals that the PBOC is comfortable with the current levels. Deputy Governor's statements about granting additional QDII quotas show regulators are confident enough to focus on further opening financial markets rather than defending the currency. Our downside scenario involves larger than expected stimulus from PBOC, while our upside scenario involves high PBOC tolerance for a yuan that is weaker. Now, looking at the US dollar, Canadian dollar, it faces two-sided risks, but with a bias toward Canadian dollar weakness. Our central scenario sees the Fed cutting rates less than anticipated, with US dollar remaining supported. The Bank of Canada cut rates in September, citing labor market concerns, but further moves are uncertain. Market pricing reflects expectations for additional easing, which could weaken CAD. So we do think that there's lingering upside risk to US inflation support, wait and see data dependent approach to the Fed easing. So what's particularly interesting for Canadian dollar traders is that unlike most G10 pairs, US dollar CAD shows positive correlation with the 2-year US Canada rate differential. Our downside scenario involves US dollar weakness supporting US CAD momentum below 1.36. with the Fed driving more aggressive cutting cycle than expected. Our upside scenario sees prolonged trade negotiation pushing US dollar CAD above 1.42. So this wildcard remains trade negotiations. Looking at the October calendar, we do have key data releases and the Fed rate decision that could provide clarity. So we do expect US dollar CAD to remain elevated with the central scenario of Fed cutting less than anticipated. And that will be all from us this month of October. And feel free to reach out if you have any questions at any point in time. Best of luck.